mention if you can move the next slide, something like that.
No problem.
Thank you. Sorry about that.
We're going to begin now. All right, good evening, and welcome to our program this evening called Financial Fitness and Economic Growth. The purpose of the program this evening is to inform our listeners about how to put our lives back on track financially, and if you're already on track, the information provided will hopefully assist you to remain on track. COVID-19 provided a gut punch to many people, both personally and professionally. As we exit the pandemic and return to some state of normalcy, it is important for all of us to make wise decisions financially in order to meet our collective goal of economic growth. This evening, we will provide an overview of issues concerning consumer debt, savings, your relationship with money, asset protection, debt reduction, credit score management, bankruptcy, and the home mortgage process. The Brooklyn Bar Association is excited to provide this program to members of our community in co-sponsorship with Investors Bank and Citizens Committee for New York City. Before we begin, I want to introduce the president of the Brooklyn Bar Association, Armina Gale, who is counsel to the Kings County Public Administrator, who will provide some welcome remarks.
Thank you, Anthony, and good evening, and welcome to this evening's webinar. My name is Armina Gale, and I am the president of the Brooklyn Bar Association. And I want to thank Anthony for putting together this informative program. Before I introduce Anthony to all of you, I would like to tell you a little bit about Anthony. Anthony is the owner of the law office of Anthony W. Vaughn, Jr., LLC. He has extensive experience in complex commercial litigation involving real estate, construction, and professional liability. He represents, among others, financial institutions, suppliers, contractors, as well as design professionals. He also litigates personal injury claims and disputes related to real estate sales, purchases, consumer lending, adverse possession, fraud and property damage, as well as transactional matters for commercial clients and individuals. Mr. Vaughn also serves as our second vice president of the Brooklyn Bar Association, and I am delighted this evening to have him put together what should be an informative hour. If you'd like to learn more about Anthony Vaughn and the association's upcoming events and programs, we welcome you to visit us at www.brooklynbar.org. And with that, I'm going to turn the program over to Anthony so that he can introduce tonight's speakers as well as to moderate the next hour. Thank you.
Thank you, Armina.
Thank you.
At this time, I want to introduce the members of our esteemed panel. First, I'd like to introduce Christina Massalay, who has worked in financial service industry for 15 years. She's a VP at Credit Suisse in the internal audit department, and has previously worked at other firms, including PricewaterhouseCoopers and Fortress Investment Group. In addition, Christina is the founder of Mass Financial Management, which was established to help religious organizations, individuals, and families identify their unique relationships with money, and in turn reconstruct, build, and manage their finances. Thank you for joining us this evening, Christina.
Thank you.
Next, I would like to introduce Joseph Lemkin, who is a shareholder and member of Stark & Stark's Bankruptcy and Creditors Rights Group. Joe's practice primarily focuses on areas of bankruptcy law, commercial litigation, business reorganization, and related matters, with a particular emphasis on creditors' rights. Mr. Lemkin has extensive experience representing mortgage lenders in both consumer and commercial bankruptcy proceedings, as well as secured creditors, creditors' committees, debtors, and trade creditors, and bankruptcy trustees. The scope of Mr. Lemkin's practice also includes assignments of benefit of creditors and chapters 7, 13, and 11 bankruptcy proceedings. Thank you for joining us this evening, Joe.
Thank you for having me.
Next, I would like to introduce Tony Zhao, a mortgage banker for Investors Bank. Tony has more than 21 years of experience providing residential mortgages in New York. A native New Yorker, Tony teaches continuing education classes for real estate agents and participates in many first-time home buyer seminars. I'd also like to add that Tony, as well as Investors Bank, has been a longtime supporter of the Brooklyn Bar Association, and we appreciate that. Welcome, Tony.
Thank you, Anthony.
Next, I would like to introduce Dr. Rahsaan Harris, who will be joining us later this evening. Dr. Harris is the CEO of Citizens Committee for New York City, who has more than 20 years of experience leading nonprofits and international grant making, partnering with communities to make local investments and promote community involvement. He's a transformative leader and role model who has been a New York City public school teacher, a board member of various Harlem-based organizations, devoted Big Brother, Big Sister mentor, a Peace Corps environmental education volunteer in South America, among other accolades. He's a man of the people. I'll tell you personally, he's a man for the people. And if you're unfamiliar with Citizens Committee, I encourage you to review their website and see what they're doing for New York City. And with that, we will begin our program.
Yep. Thank you so much, Anthony, for your lovely introduction. And so one of the things that we do want to encourage everybody while we're just getting started is that, as Anthony mentioned, is we want to just help people, and we just want to encourage everyone as well that you can start anywhere at a point in time. So don't feel that if your particular situation may look bleak or anything at all, do not feel that there is no hope. There is definitely hope, and there are strategies that you can employ to rebuild.
So, Christina, are you able to see the screen? The slide?
I'm not able to see the screen, but
Hold on
I'm able to see it now. Yep.
There you go. Thank you.
Awesome.
So, Christina, as we begin, I know that many people believe that they are too old or not old enough to save money. Can you share some of the conversations that you have with your clients concerning the issue of savings?
Yeah, definitely. So in terms of savings in particular, you can start at any age. You don't have to wait until you're 30 and your 40s and in your 50s. Actually, the younger you are is better to start saving, just because of the theory of compounding interest. And what that means is that the money that you have that's saving, and in particular, if you have it in investments, it will continue you'll earn a return on top of the return, right? So if you invest a certain amount of money, if you invest $100 and you earn 10% on that money, and then the next year you earn $10 on that money at the end of the year, let's just say, and then the balance is $110. So now the compounding will start not from the 100, but it will start from the ending balance, that $110 and so forth and so on. So we just want to encourage everybody that you can definitely save, and savings by age, when we look at it, in America, these are stats that were in about August 2020. So during some point during the pandemic, overall during the pandemic, we saw people started tightening up the belt straps, and savings overall went up a little bit. But we're still not where we need to be, particularly in this country, because the saving rates in other countries are much higher. So for instance, if we look at the age group, the average balance for a person who is 35 to 44, the average savings that person may have is $25,000. And with this aside, this is just by age group. So this doesn't account for with children or if someone has a family, right? But let's say if we look over at the household level, we see that average savings balance tends to go down if someone is single with one or more child. The amount of money that's saved is $11,700. For couples, you have a dual income household generally, and if there's one or more children, then there's about $42,800 in savings, which is something, but it's still depending on what the average person's expenses are or their run rate to run their home for the year. It may not be enough of an emergency fund for that particular family providing if there's any medical emergencies or someone loses their job, that money will go relatively quickly. And then if we look at the savings rate broken out by race, the numbers are a bit more stark, right? So the average savings balance for someone who is Caucasian is 51,400, as for compared to African Americans, 8,600, Hispanic, 16,700. And this is something that we even saw exacerbated during the pandemic as well. I know Credit Suisse came out with their global wealth report yesterday. So every year, Credit Suisse issues a global wealth report, and it's looking across wealth across the globe. And what was really highlighted is the increase in the wealth gap and how stark it is. And so that's something that we probably can share around with folks. It's public information. And so we encourage everybody, the more educated someone is, the more knowledge that they'll have about financial literacy, and the average savings balance will go up as well. But Anthony, to answer your question, we can start saving at any particular point in time. You would want to not just save money by putting it into a bank account. You would also want to get into some type of investment strategy, whether that be investing in stock markets, whether that be investing in real estate, but something where you're going to earn a return on your money.
Right. And that's a great point there, Christina. And some people, they forget about the purpose of a savings account, or a forced savings with our 401ks. We strongly encourage people to utilize the 401ks, enroll in them, maximize as much as you can that you've set aside, because ultimately your lifestyle will change, your behaviors will change, because if you put that money away up front, you're less likely to rely upon it going forward in the future. You'll just take whatever your net income is that you take home and try to do better living within your means, which again is what this program is about. You also have money market account options. You have certificates of deposit options. You have IRA options. And of course, as we have children, we can't forget about the college savings accounts, otherwise known as 529 plans. So all of these vehicles are available to people to save money for whatever the goal is, whether it's paying for education or whether it's buying a home one day or some other agenda item you have, opening a new business. But we do recommend seeking a qualified financial advisor so you avoid recreating the wheel.
Yep.
Then the next slide we want to talk about now, is, Christina, we've heard many theories about credit cards and how many cards to have and whether there's a healthy amount of debt to carry on those cards. But at the end of the day, whether it's a bank card or a department store card, it's still just borrowing money, isn't it?
Yeah, definitely. You're still borrowing money, which has to be paid back. And if it's not paid back at the end of the month, you get charged a sizable amount of interest. Many times these credit cards, your interest rate are upward north of 20%. And so it's definitely imperative that we make sure that there's a strategy that we're employing if we're using credit cards in particular. But there are several myths about money. So some of them that I've heard in particular is I should leave a small balance on my credit card to increase my score. Now, there's two different things. You should definitely use your credit card, and if you don't want to spend a lot of money, you should definitely incur some small expenses on your credit card. But you should pay your credit card off at the end of each month to the extent that you can, because that's what's going to help you to pay your score off sooner. So when we're talking about a FICO credit score, in terms of one of the greatest factors that impact your credit score is paying your credit card balances on time, right? So that's about 36% of your card just to pay it on time. Now, obviously, if someone is not in a position, let's say you have a $10,000 amount of debt on your credit card. You can't pay off the entire chunk. You definitely want to, at a minimum, pay what is the minimum balance on that card, and then develop a plan to pay it off soon, because the dress that you purchased that was $200, down the line it may cost you $400 or $500, or the sneakers that someone purchased, or the golf clubs that someone purchased for a particular amount, it could cost double if we're not careful. Another myth is, I won't go through each and every one of these, but that debt is expected and unavoidable. So I hear people say, you know what, I work hard, I deserve this, and by any means, I should therefore have it. And that is a part of life. And so I'm just going to do XYZ. I had someone tell me that they knew that their credit was going to tank. And so what they did is upgraded their car right before that and got into more debt and took out a higher note on a vehicle, which didn't make any particular sense whatsoever. That's a situation where I would say debt is unavoidable if you have a strategy and that person didn't necessarily need to get that particular car and they had a new car already that was working fine. Another one that I see people do, and this I've seen some people do it during the pandemic. So under the CARES Act, their rules were changed where you could take money out of your 401k because these were dire times, right? This was just during a certain point of time during the height of the pandemic. You could take money out of your deferred tax asset. So whether it be a 401k or a 403b or some other type of vehicle, without being charged the early withdrawal 10% penalty. You're still subject to taxes. However, you're not subject to the early withdrawal penalty. But people, irrespective of even if the penalty is in play, people still take this out and feel that, okay, I'm going to pay myself back. So one of the things that we like to remind people is that you can borrow for anything else in life, but you can borrow to buy a home. You can borrow to send your kids to school. You can borrow to buy a car. But when it's time for retirement, you cannot borrow for retirement. So this is something that you want to have a strategy to build out retirement. Another one that I'll highlight on is my partner takes care of our money, so I don't have to. In this day and age, I think it's wise for, if people are in a relationship, whether married or in a partnership, know what's going on, know the state of affairs. Don't leave it up to just one person, because God forbid something happens, then everyone is in the dark and everyone is scrambling. And what we saw during COVID, it kind of woke people up a bit to try to ask the tough questions and figure out what is the state of affairs, what is our financial situation, what type of insurance do we have? Do we have any insurance? Do we have a will? What happens, God forbid, if I pass away? And sometimes these are things that we don't want to think about, but it's very important. What happens to our children? Who would be their guardian, essentially, right? So we want to definitely make sure everybody is in the loop. And sometimes we don't all have the level of sophistication, right, to handle the finances. Bring a professional on board, right? Whether it be a lawyer dealing with your trust and estate setup. God forbid, even if something was to happen, you can contact the lawyer. They have all the information. You can contact the investment manager or the financial advisor, and they'll have all of the information.
Thank you, Christina. That's a very wise recommendation. I think it's also necessary for each of us to, as Christina said, we need to look at our spending habits. We feel like by any means we need to get it because we want it, but sometimes we just need to make just some adjustments in our spending habits, and we could end up saving significantly more money. Some suggestions in our everyday lives: eat out less often. I can tell you, as a result of COVID, a lot of studies showed, in the news was constantly reporting how for some people savings was going up because we weren't going anywhere. We weren't spending money on gas. We weren't spending as much money on food, at least going out to eat. So my recommendation, get it reacquainted with your kitchen. It's not decorative. It's not a living room that no one's permitted to sit in unless the company's visiting. You can eat breakfast at home, brew coffee at home, take it with you. There's no need to purchase $4 coffee and a $3 breakfast sandwich every day. Maybe treat yourself one time per week. Also, take your lunch to work a few days a week. You can bring leftovers to work, prepare your own salads and bring them. The salad at the local deli is not much better than what you can make at home. And at least this time, you'll know what's in the food and you can monitor your consumption. The bigger the salad, the bigger the proportion, the more we're going to eat. We're all guilty of it. And while eating dinner out is fun, it's also really expensive, especially if you're going to drink alcohol. So another recommendation is, maybe if you want to go out, consider a BYOB. Again, this is the smaller adjustments to avoid the markup, like on alcohol. Can you still have a pleasant evening out, but spend less money to stay on track? Obviously, and then just as important when it comes to maximizing, changing your spending habits and all, be organized. Be organized with you, and we'll get into that a little bit later. Be organized with your expenses. Monitor it. It's not. Don't just rely upon your bank account on the internet. Consider what's going out. Consider what's bringing in. You'll be surprised at how much money we spent each day just in our day-to-day activities. So I want to move on now to discuss some just financial basics and our relationship with money. Here, Christina, I would say, we encourage everyone to determine their net worth, but not everyone knows how to do that. Can you explain for our listeners the financial basics and how to perhaps perform that calculation?
Yes, definitely. So sometimes also, thank you for that, Anthony, because people look at what's in their bank account, maybe what they have as cash, and that's all that people focus on and determine that, okay, this is the value that's associated with myself. And it's really important that you want to make sure you know what a balance sheet is, and at least what your personal income statement is, right? And so on your personal balance sheet, everybody has one. Now, what those numbers are on that statement is going to look different for everyone. So you have assets and liabilities, right? And so if you're familiar with companies also have assets and liabilities, but instead of saying net worth, you'll see something that says like shareholders equity, members equity, or just straight equity. But net worth essentially is your equity. So think of it as if you own a home, you take the principal balance and you then subtract the liability, the debt that you owe, or the fair market value of the house, and then you subtract out the liability, you'll get at your home equity in the home. It's the same way for your personal financial statement. So you just want to take all of your assets, which your home is one of those assets, your cash that you have is an asset, any type of investment that you have. A lot of times people have jewelries, they have the antiques, there's artwork, and some of that artwork, I'm not talking about some of your kids' artwork that they made your picture for you. That's cute, it's great, but there may not be a value that's subscribed to that. So let's if there's certain things that you have to get appraised, these are all things that are assets, right? So you want to add all of those things up, and then we want to look at what's on the liability side. So what do we owe essentially? And those things could vary. We talked a bit about credit cards. It could be student loans. It could be car loans. It could be personal loans. Maybe you borrowed $20,000 from your sister or from your brother, and now that's a liability that's owed. So you want to take your assets minus liabilities, and that's what will give you your net worth. These calculations are very important because when you're going to get all of those assets, they look at your net worth. They look at a whole bunch of other ratios that are run just to see how you are managing your finances as a particular individual, right? And then if you want to see and calculate for yourself to get a sense of how much am I spending relative to my income, right? So it says revenue on the slide, but revenue is more for companies, but income would be more appropriate for us as individuals. Let's say you get W-2 income from a job that you work at, or you get self-employment income, or you're collecting unemployment income. It's still a form of income. And guess what? All of these types of income, we're subject to taxation on it. So we're not going to get the full gross amount of it. So whatever is the net amount, that net income, then you want to see what your expenses are. But let's say someone, there's people I know, for instance, who make loads of money. Let's just use a round number. Let's just say someone makes $800,000, right? But let's say that their expenses, they make $800,000 for the year. Let's say they pay taxes of $200,000. I'm making these numbers up, guys. So don't quote me on my math and say, oh, Christina, well, that's not really the 37% tax bracket and you're a CPA. I'm just making up numbers. All right. So $800,000 income, $200,000 in taxes. So that's $600,000 that's left over. But what if every year this person has expenses that are $650,000? They're already in the hole $50,000. So a lot of times I hear people, oh, that person is wealthy, that person is rich, and they make a lot of money. It's not necessarily about the amount of money that you make. It's about how you manage the money that you make, right? So that's something that's very, very key, because there are people who live better, who make less, than people who make more, because they're managing so many other types of expenses. So it's really good for everybody to look at their income and say, okay, maybe this person brings in $80,000 or this person brings in $300,000, but what percentage of my income are my total expenses, right? So if you want to know what your net income is, you just take your income minus your expenses, you're going to get to your net income. If you run a business, you take your revenue minus your expenses and you'll get to your net income. And that's anything that's left over. And a lot of times people will invest that money or put it into other income generating activities.
Yeah, thank you for that, Christina. Another, just quickly, I'll just add, once you acquire those assets that Christina was talking about, such as, artwork or jewelry, you need to protect your asset. And by that, I mean, get property insurance. You should also, as you acquire assets, a lot of people, unfortunately, forget to obtain wills. So they can make sure that they have input on directing where their assets should be transferred to upon their death. Don't make that same mistake. You've worked hard to acquire these assets. Make sure they're transferred in a way that you want them to be transferred. Consult your local, an attorney or a trust and estates practitioner who can provide guidance to you. And lastly, don't forget about your own health and your body. All right, that is an income generator. If you're not healthy, you can't earn income, or it's going to be very difficult. So you should consider appropriate insurances such as disability insurance in the event that you're injured, or even life insurance in the event of an unfortunate passing. But at least your family will be protected and be taken care of. And again, insurance is still part of your overall financial plan. Don't forget about that as an option. Next, we want to move into discussing debt reduction. And I'm going to, sometimes we incur so much debt related to student loans or medical bills or credit cards that we don't know where to begin in order to get on track. So I'm going to invite Christina and Joe to discuss the whole process of how to reduce the debt that we have. Christina?
Yeah, definitely. So we talked a bit in the beginning about, let's say, if you had credit card debt, or if it could be from a car loan or any type of debt, right? There's different methods that you may want to employ based on your personality type, right? And so we'll just align the snowball effect and the avalanche method. So if you're the type of person that would like to see progress quickly, the snowball effect may be more appropriate for you, right? Where you start off paying a smaller balance, your smallest debt balance that you owe, and pay that off. And you start just tackling all the small ones, and then you move up to the larger ones. What that does is that allows you to build some type of momentum, and you'll feel really good that you're making progress, and it'll encourage you to continue on and pay down the rest of your debt. And some people will say, look, I want to pay off my debt as fast as possible without paying more interest on it. And if that's the case, you would want to focus on paying the highest interest balance first. And that's more of the avalanche method, right? Let's attack it. Let's get the large chunks, attack it, and just get it over with. You can increase your monthly payments. Like some people I know, they pay double the monthly payments, triple the monthly payments. They get a large amount of cash, and then that just goes to pay down additional principal, right? Some people pay extra payments for their mortgages every year. One extra payment, it cuts off several years off of the overall life of your mortgage. Let's say you have a 30-year mortgage, you can definitely skim a few years off of that by paying one extra payment per year. So some people will do the increase in the monthly payments, or some people will say, you know what, I've established such good habits during the pandemic. I am going to now, they say 21 days, right, to create a habit. So we're pros at this point, right? We are seasoned because there's been a lot of 21 days that have accumulated. So now maybe people want to take those habits and say, okay, as Anthony mentioned already, I'm already good not going out to eat as much. I still want to enjoy that, and I'm going to go out sometime, but I'm going to change some of my behaviors, right? I'm going to stop incurring new debt. I was able to live during the pandemic and I was okay. And I realized that I didn't even need as much of some of the things that I have. So I'm going to start selling some things, right? This is not for everybody. I don't want people, Christina told me to sell this, and then you get into an argument with your spouse. That's not what I'm saying. It's not an excuse for you to go and sell your spouse's thing. But just we can change behaviors. And then lastly, some people think that the tax refunds is free money. Please, it is not free money. That's your own money that you're getting back that you probably should have gotten back during the year if you would have changed some of your withholdings on your form. But some people use the tax refund if they're not, getting what they should be getting all through the year, and they use it as a savings mechanism. And so they obtain their tax refund and they use it to save, or they use it to pay down debt. And then some people just use it to do other things as well, maybe for the family vacation and maybe for something fun. But you can consider using it to pay down your debt as well.
And so I think we wanted to move on. Thanks, Christina. I thought that was really good. Those are some helpful tools in helping starting a debt reduction for your own family and your. But there are a couple other tools that we have here listed. One is the credit card balance transfer. And I think it's something that we probably see in the mail all the time, opportunities from different credit card companies for to transfer from one credit card to another. And that many of these are really good opportunities. That sometimes it'll be zero if you transfer over from another credit card to you could have a 0% interest. The only thing you have to be cautious about sometimes, first of all, there's a fee. It could be 3-5% or more to transfer over. So if you transfer over $100, it's going to cost you $3 to $5. And if you plan on paying it off, that's just a number. Like Christina said, I'm just using as an example. But bottom line is, if you don't want to have to, you want to, if you're going to be paying a huge fee, but you're going to you don't want to pay that fee if you're able to pay the debt down more quickly. And another issue could be that even though you're getting the balance transferred to a new card, and maybe it's only a small fee, but sometimes they quickly they pivot. It will give you 0% for a few months, but then they pivot to a very high interest rate. So you may be getting yourself, oh look, I got a few months of a really low interest rate for a small fee, but then I'm back in the same problem. So you just have to really be cautious. The credit card offers that speak to this, they have to have certain disclosures, and you really need to be careful in reviewing those disclosures. How many months is this for? What are the fees? And I think there are good opportunities out there. You just have to be cautious.
Mm-hmm.
Then another issue is debt relief. I think we're talking about here, there are third-party debt relief agencies. A lot of times we hear about them in bankruptcy court. So, and we've noticed here, be careful, they can backfire. One issue is, I'm thinking in terms of backfiring, is that some of the candidly, some of the companies that are out there that are dealing with debt relief, they're on tow, or they're not really looking out for you, and they're looking out to make a profit. So you just have to, be cautious, do some research on the company you're going to use, and make sure that they could help you reduce your debt. But the other way that I was also thinking that it could backfire is that, great, you got all this debt reduced. Now you have kind of a clean slate, or but now if you don't change your spending habits, which Christina was talking about, if you don't change your lifestyle, like Anthony was talking about, you're just going to go back into the same system of spending and incurring more debt, and you're not going to, you may have gotten yourself out of a hole, but you're going to dig yourself right back in.
Mm-hmm.
So the last one is debt consolidation, and similar to debt relief, this is when you potentially you could get either a loan or use other credit cards to consolidate all your debts, but again, maybe a good opportunity, but similar to what I was saying before, one, there could be, especially for some of these debt consolidation loans, the interest rates could be pretty high. They could be, and they could have the interest rate, even though you're consolidating, may ultimately be higher than what you're paying. So you have to be cautious, and okay, I'm consolidating, but am I really getting a better deal? And also, in addition, similar to the credit card transfers, you may have issues in terms of the fees to be paid up front. Some of the debt consolidation loans have significant fees. So again, the similar issues with fees and the interest rates spiking. And also, a lot of times these debt consolidation loans, maybe they give you a lower interest rate, but if it stretches it out over a long period of time, but you're still paying even a lower interest, now you're still paying it over a longer period of time, but so the interest you're paying is the same amount as you would have under let's say a higher interest rate. So bottom line is, you just really need to read the fine print and figure out what you're getting into, because sometimes it's not beneficial. And again, like we said with debt relief and credit card balance transfers, here again,
Yep.
if you consolidate all your debt, now you have a small monthly payment for this consolidated debt, and now you start spending other monies and incurring more debt, you're just back in the same hole. So if unless you're going to set up a new plan and really a new plan of spending, a lot of these tools are not going to help out. So it really needs to be a global spending and debt relief plan.
Yeah, thank you for that, Joe.
Yeah.
And I'll also add, just with regard to communicating with creditors, just briefly, just make sure you don't avoid your creditors. Don't put your head in the sand in the event that you get behind on a payment. Oftentimes, the creditors are happy to receive communication from a debtor. They want a performing loan. They don't really want to spend time and resources chasing payments. Negotiate a proposed payment plan if possible. During the pandemic, we saw the various governments implement moratoriums, some of which remain in effect. Take advantage of those moratoriums to buy yourself some additional time in order to get back on your feet. Again, a lot of unexpected challenges were presented to many of us over the course of the last year and a half. Don't look upon yourself as like it's your fault, but take advantage of these other opportunities. And lastly, like I said, be organized, communicate, and it'll make life a lot easier in terms of the debt reduction process. We're going to move on now to, we were going to get into just briefly about the FICO score. Christina, do you want to speak about this just very briefly? And then we'll move on to the next topic.
Yeah, I think I spoke a bit about this. I mean, the key thing, obviously, the higher your score, the better, right? You want to get into the 700 club, and the picture demonstrates that. And then some of the things you want to look at, this is your FICO score composition. This is not for the Vantage score, which is another credit score. And you want to focus on mostly paying your card off timely, and then your credit utilization, which means that, not that the other things are not important, but that's already 65% of your score, right? So if you have a credit limit of 10,000, you don't want to already have your utilization at 8,000. You only want to have it at about 3,000, right? So that it's not above that threshold. a particular threshold. So that's all I will say about this slide.
All right, thank you. And next, sometimes, we recognize the reason why we included bankruptcy in the financial fitness programming is because we recognize occasionally circumstances arise where bankruptcy is unavoidable, and it should not be considered, some sort of stigma because it's ultimately necessary for you to file for bankruptcy. And so we've asked Joe to speak a little bit about what bankruptcy means, and what's involved, the process that's involved, and the potential benefits associated with it. Joe.
Thank you, Anthony. I guess I may have drawn the short straw to be presenting on bankruptcy, but it's my pleasure. And so we'll start out with basically what is bankruptcy, and it's a legal process that's initiated in the federal court system, which can be utilized when a person is unable to pay their debts. These are federal laws and court proceedings designed to provide individuals or businesses with a way to address debt problems. It could be either you have an accumulation of many debts over time because of smaller issues, or it could be you suffered a medical or big crisis that caused a significant amount of debt that just you'll never be able to pay off. So it really provides an opportunity to resolve any type of financial issue. And as Anthony said, it's an important part of financial fitness because before you can take steps forward and make progress, you need to fix a serious problem. It's just like in physical fitness. If you have a broken arm, you can't work out, you can't build up your muscles. You first have to put your splint on. So many times, if the situation is so bad, bankruptcy is like your splint to start the recovery process before you could really get to the next stage. And like Anthony said, there should be no stigma. This is bankruptcy is provided for in the Constitution. There's really nothing to be embarrassed or ashamed about. In fact, if you look at the top companies, many retailers that we shop at every day have gone through bankruptcy. Sears, Toys R Us, JCPenney, Lord & Taylor, Men's Warehouse, and even, believe it or not, Chuck E. Cheese. So with all these bankruptcies, if there's you have individuals in dire circumstances that need to use it, and even it shouldn't be something that we attach a stigma to. And it's interesting. Today I was reading on a website that there and you've probably heard of many celebrities or athletes that have filed for bankruptcy, but today I read one that was pretty astonishing. There's a professional hockey player for the San Jose Sharks. He's named Evander Kane. He's an 11-year NHL player. He's accumulated over $50 million in earnings and his salary alone from the NHL. And then in 2018, he signed a 7-year contract for $49 million. So here he's made $50 million. He's going forward with a $40 million contract, but and this kind of speaks to what Christina was saying, but his expenses were massive. I think he was spending $93,000 a month on cars. But either way, he's filed a bankruptcy and the court is letting it proceed. So, and some may see that as abusive, but if Evander Kane, the $50 million hockey player, can take advantage of it, certainly, a layperson or a professional that's suffering some financial dire circumstances is absolutely entitled and should, make use of the bankruptcy process. So anyway, as far as the purpose of the bankruptcy is really twofold. One, it provides the person filing for the bankruptcy a fresh start. They could get started on their way back to financial health. And two, it allows for fair treatment of creditors. So basically that's saying, hey, you have credit card debt, mortgage debt, secured debt, unsecured debt, and we could explain in those phrases. But bottom line is everyone should be treated fairly. And no one, not one creditor, you shouldn't be able to prefer, oh, look, that's, a close kind of friend that I owe money to. I'm going to pay him whatever I have, and I'm not going to pay my other creditor. So it provides a lot of transparency and a balanced system so all creditors get paid, if anything, at least equally. So I was going to go on to some of the definitions we have here, debtors and creditors. So just to, maybe I should have started with this and I apologize, but a debtor is the person or business that owes the money in exchange for loans or goods or services that are purchased with credit typically. And it's the debtor who files the bankruptcy due to large debts that they can't pay. Now, along with the bankruptcy, you're basically filing. It's interesting. Christina was talking about your assets, liabilities, balance sheets. That you file petition and schedules, and that basically what it includes. It includes all of your assets and all your liabilities. But maybe if we listen to Christina and think about that well ahead of time, we won't have to prepare it in connection with the bankruptcy. But that's basically what you file to start the bankruptcy. It's a petition, say, here, I'm filing bankruptcy, and it's a statement of, here's all my debts, here's my income, and here's all, my liabilities and debts, and here's my assets. So it gives the court a snapshot of what your financial situation is. Then on the other side, the other constituent is the creditors. Creditors are a person or an institution that lends money or is owed money by the debtor. It could be banks, finance companies, credit card companies. The interesting thing is you typically think that it's the debtor, and I said the debtor files the bankruptcy, but you don't see this in the individual cases so much, but it is more times, sometimes in business cases where you could, creditors can join forces and force someone, a company into bankruptcy. It's called an involuntary bankruptcy. Hopefully no one would ever be put into that situation. That's generally where someone is acting fraudulently and not paying debts, not being responsive, not communicating. Then the creditors feel like they have no option but to force a bankruptcy so they could get the necessary disclosures and information they need. I was just also going to talk about some of the other players in a bankruptcy case. So the main other players, you have the court. That is the judge. It's a court system, and it basically the judge is like an umpire. He's making decisions, calling balls and strikes on what different creditors and debtors can or cannot do under the law. And the law here that we're talking about is the Bankruptcy Code. The Bankruptcy Code provides different, basically all the laws on what a debtor and creditor can do in a bankruptcy case. Another important actor in the case is the United States Trustee's Office. They're a part of the Department of Justice. They oversee the process. They're just like a watchdog to make sure that everyone's acting properly. They're not calling balls and strikes like the judge, but they're more in an oversight position. Next, if you file certain types of bankruptcy, you'll have a trustee appointed. And a trustee is basically when you file your petition and schedules that list all your assets, he or she, the trustee will see, okay, they have, they have a house and but they have this other property, a vacation home, and then they have another property. Well, you know what, they're going to need to sell at least some of that property in order to satisfy your creditors. You have to, basically the trustee comes in, marshals assets, and then redistributes those assets, liquidates the assets, sells them, and then uses those the funds from those sales, that disposition, to pay off creditors. But we could talk about that later. I don't, tip in most cases, there's really not much for a trustee to pay out, but in certain circumstances, if there are significant assets, then the trustee may do so. Now, this is a good segue to talk about the different types of bankruptcy. We have here listed the three main ones that we would be concerned about are Chapter 7, Chapter 11, and Chapter 13. Now, Chapter 7 is often considered the straight liquidation. It is available to individuals and businesses with insufficient income to pay their debts. There's a little bit of a test that you have to go through to make sure your income is low enough to be in a Chapter 7 for straight liquidation. If your income is too high, you may need to file a different chapter or type of bankruptcy in order to make some sort of payment plan. But if the means test show that you're making less than the typical person under IRS guidelines, you're usually going to be able to file the Chapter 7. And then, as I said, the trustee will be appointed in a Chapter 7 case, marshal any assets that you may have that could be used to pay creditors, and then distribute it to creditors. that being said, I think the one very important thing to know is, even though it sounds like, oh wow, this trustee is going to come in, they're going to take my stuff and sell it and pay creditors, it's really not like that, because many, if not most, of your assets are exempted from the bankruptcy. That means you file bankruptcy, but you get to put like kind of like I don't know, a guard, a cage around certain assets, saying, okay, I filed bankruptcy, but you can't take this and you can't touch that, because they're all protected by the process. I'll just give you one example, because I think it probably speaks to the enormity of how big these exemptions are. But you can retain a fair amount of equity you have in your residence. And I looked this up in the New York City area. You could keep up to approximately $170,000 of equity in a home. Now, if you go the further away in New York City, from New York City and New York State, it decreases. I think outside of New York City, maybe it's $85,000 and so forth. But bottom line is, in the New York City area, if a couple files bankruptcy, they're both entitled to that exemption. You could literally exempt $340,000 in equity. So that's just an example. There's many types of exemptions you get in cars, in bank accounts, and some wild cards. So if a concern of filing bankruptcy is that I have certain assets, most assets will be protected. And if you're in a financial condition where you're not paying your debts as they come due, you could still protect your assets and take advantage of the bankruptcy process.
Hey, Joe,
Yes.
I was wondering, do you think maybe this would be a good opportunity maybe to segue into, now that we've laid the foundation and gotten rid of, discharged some of the debts and used the splint, as you stated, you think maybe this might be a good segue into the mortgage lending process?
Yeah, absolutely. I think that would be great.
Okay. So at this time, I'm going to turn the program over to Tony from Investors Bank. Just give me one moment here. And Tony, are you able to see the slides?
I am.
Okay, so take it away, Tony.
Yeah, thanks, Anthony. And if you would go to the next page, that'd be great. Thanks, everyone. My name is Tony Zhao. I am a residential loan officer at Investors Bank. And I think when people are thinking about that initial investment, which is your first home purchase, buying a home is a very special thing. It's where you grow memories, spend time with your family, raise your children. And this is something that is very important because it is some of the largest investment for most folks, or it's their largest investment. The second that pops up in your head and you're thinking about buying a home, the first thing you should do is think about getting a pre-approval. So pre-approval can be done by somebody at a bank, somebody whose title is a loan officer, somebody who is a mortgage broker at a mortgage broker shop. And what that does is it gives you a financial roadmap, right? It gives you, it tells you what you can afford as a homeowner when you're looking to buy, especially now, how crazy, I like to say, the housing market is right now. I don't think you can go see an apartment or a home or a listing unless you have a pre-approval, right? Because that's how much demand there is, mainly due to mortgage rates and interest rates. So starting that home process with a pre-approval should be done at least 90 to 100 days before buying, because you need to have that loan officer look at your income and look at your assets, and they look at your credit. Now, banks are going to look at your income. If you're a W-2 employee like myself, bring your W-2 and bring your pay stub, and that loan officer will tell you what you can qualify for. Now, if you're self-employed, it becomes a little more challenging, because remember, when you're self-employed, you're doing tax returns for the last 2 years, and banks are going to want to see 2 years of tax returns to ensure that you have the ability to pay that mortgage, especially now. So if you haven't done 2020 tax returns, then what you should start doing is look at putting them together, or put together something called a profit and loss statement, because that's going to show the bank your ability to pay the mortgage and that your income has not suffered due to COVID, because they do need to prove that when they borrow money from the Federal Reserve. Now, one thing I see a lot of is funds being used for a home purchase. I cannot tell you how many mistakes people make when buying a home. Now, there's something called the Patriot Act. The Patriot Act makes loan officers such as myself, and I would say, banks, they make us police officers, because the Patriot Act, they want to see where the funds for a purchase comes from. They want to make sure that your down payment and closing costs are not borrowed. They want to make sure that it doesn't come from illicit gains, because a lot of people use that to launder money. So they want to make sure that when you're buying a home, the funds used for a down payment is coming from legitimate sources. So when banks look at your down payment and closing costs, they actually look at 2 months of bank statements before you sign the contract. And my team and I, we actually look at every single deposit in your bank statement. And if there's a deposit that you cannot show, you may not use that. I've known people that were approved for a mortgage, and then they deposited cash into their account that they cannot explain, and they were turned down prior to closing. That's how important it is for you to know and source where the funds for your down payment comes from. And lastly, credit report, credit score. That's very important. I think Christina, Anthony, and Joe spoke in depth about this. Remember, money is risk-based. The lower your credit score, the higher your interest rate. So knowing your credit score 2-3 months in advance, and if there's any hurdles and issues, you can fix them. You can manipulate credit prior to going and applying for a credit. And that's something that a lot of bankers can help you with. Anthony? So in New York City, when I talk to a buyer, the first thing I tell them is that in New York, 70% of buying a home is about the building you're buying in. It is not about your income, your asset, your credit. If the bank doesn't like the condo or co-op or the building you're buying in, they're not going to lend to you. So these are some of the things that banks look at. If one entity owns more than 20%, they won't lend in a building. If there's a litigation, if there's a large percent of commercial space, anything over 35%, the banks won't lend in. If there's one entity that owns more than 50%, or if the project is investment properties, the bank won't lend in. And if a property is on a proprietary lease, the bank will not lend it. Remember, the banks are putting up 80% of the money usually, or whatever you're putting down. So we have a lot of skin in the game. So we want to make sure that anything happening to the building doesn't trickle down to you, because as a shareholder of any co-op and condo, you could have adverse effect if the building has any issues. Anthony? So obviously these are dues. I think it's very, common sense, but people do make a lot of mistakes. Pay your bill on time before you start buying a home or during that process. Keep paying your rent. Banks right now are doing a verification of rent 5 business days before closing. A lot of moratorium on rent has been given. And if you haven't been paying rent, you're not going to be qualified for a mortgage, because the bank's going to say, if you can't pay your mortgage on time, why are we going to give you a 6 to 7 figure loan if you can't pay that rent on time? So it's very, very crucial that you do pay your rent on time. Save your pay stubs, keep working. The Federal Reserve has asked banks to do a verification of employment 5 business days prior to closing. There are folks that have been laid off and they're still getting paid. So they're giving paychecks to the bank. So the bank and the Federal Reserve wants banks to verify that this individual buying a home has the ability to pay their mortgage. So we do a verification of income or employment 5 business days prior to closing. So these are things that you must let your lenders know. And of course, in anything, asking questions. Sometimes I'll spend 30, 40 minutes with one client because I think it's so important that you ask anything you possibly can think of. Don't lose sleep at night because you have questions that go unanswered. It is very important you work with a knowledgeable loan officer. Anthony? So I can't tell you how often I see this. Somebody gets approved for a mortgage. They're about to move in 30 days. All of a sudden, they go out and they start shopping for furniture. Or, we have a lot of folks in New York City moving to the suburbs. When you live in New York City, you don't need a car, right? There's no reason for an automobile. But if you're moving to New Jersey, Westchester, Long Island, now you're saying to yourself, wow, I need to buy a car. And when you incur a large expense, that hurts the debt to income ratio. So prior to closing, banks are going to do a soft credit check. And that soft credit check is going to show up where you have a new car, you have new furniture, and the file has to be re-underwritten. And that goes the same with applying for new credit cards. These are all things that people do. And of course, that makes sense, right? You want to get a new car, you want to get new furniture. But my advice is talk to your banker. If you have a very low debt to income ratio, then absolutely you may do so. But please let the bank know. And certainly, as I mentioned, incurring large infusions of cash, that is a huge no-no. Cash cannot be traced. We don't know where that's coming from. We don't know if it's illicit. These are all things that will get your loan declined. Remember, if a bank gives you an approval, that does not mean anything. They have the ability to withdraw that commitment. They're under no legal obligation. In that commitment letter, it's going to say they have the ability to take back that commitment if you don't meet the terms of the loan. Anthony? So why you're seeing such a huge influx of purchases, my opinion, is interest rates. Low rates. I've been doing this for 21 years. I've never in my career have locked a loan for 2.5% on a 30-year fix. That is literally almost free money. If you think about mortgage tax deduction, depending on your tax bracket. So prior to COVID, rates were at about 4%, 4 1/8. If I locked somebody in at 3.75, they were jumping for joy. Right now, interest rates teeter at about 2.75. And if you look at this chart, you see where things were and you see where things are now. Could you imagine taking out a $500,000 mortgage at the current rate of 2.75 versus 4%? You are talking about anywhere from $300 to $1,000 difference in payment depending on the loan amount. And could you imagine over 10 years how much money that is? Or over 30 years, you're talking about 5, maybe 6 figures in difference on interest rates. So we all know, and the feds keep coming out mentioning that inflation, right? Inflation's at an all-time high. Mortgage rates are tied to the 10-year treasury bond and also inflation. And when we have high inflation, rates are going to go up. It's a no-brainer. So a lot of economists predict by the end of summer, you should see rates go back to pre-COVID numbers, which were 4%. So I always tell folks, I think negotiating over a few dollars, closing cost, or whatever the case may be, may not be as important because when rates go back to 4, your ability to pay the mortgage and your affordability is going to change. Anthony? And this just, I'm a visual person. When I look at numbers and you look at how much rent that you pay on a monthly basis versus how much you pay over 1 year, 5 year, this is money that you're throwing down the drain, in my opinion. You're not building equity. You're not, building your asset after retirement. You're not getting mortgage interest deduction. And Anthony, sorry. This is a rent versus buy calculator. You can reach out to me. Anthony can send it to you. All you have to do is plug in how much rent you pay, mortgage loan amount, down payment, And it actually tells you how much money you can save by owning a home. And like I said, not everybody will benefit from owning a home. But if you have the ability, if you have the capacity to buy a home, in my opinion, it is absolutely worth it. Thank you so much.
And thank you, Tony. I tell you, when we have these discussions, I'm always reminded I wish someone was in my ear when I was in college, or even in law school, to start looking at these things sooner. I'm always kicking myself that maybe I got a later start, but all of this material that you all have shared with our viewers has been incredibly valuable, and we hope that each of the viewers feel the same and able to take one or two things at least away to help improve your agenda and your collective goal to reach financial fitness. At this time, I want to reintroduce Dr. Rahsaan Harris, the CEO for Citizens Committee, to share a few words. And then when Dr. Harris is finished, we're going to respond to any questions that have been submitted. So, Rahsaan?
First and foremost, Anthony, thank you so much. I want to thank the Brooklyn Bar Association and Christina and Joe and Tony. It's just such an honor to be able to get access to information. Again, the disclaimer, this is not advice from your lawyer or your financial wealth manager. This is great information that you can go to those folks and ask them critical questions to figure out how you can be financially fit, how you can be part of New York City coming back. Citizens Committee's mission is to bring New Yorkers together so they can improve their neighborhoods, and particularly making sure that all have access to opportunity. And that starts with ownership. That starts with people being fit in themselves. As they come together, communities are healthier, and neighborhoods and New York City is healthier. So thank you for sharing this information, for motivating us and making sure that we're curious to see what we can do to better ourselves, because it's not just about ourselves, it's about the broader community. So do not keep this information to yourself. If you get access to this link, share it. Make sure that folks are curious, because you're passing on a blessing to them so that New York City can do better. We are in the midst right now, Citizens Committee for New York City is in the midst of a campaign, New Yorkers for New York. We're all New Yorkers for New York, because our bravery, our activity is what's going to make sure that we rebound and we are better than we ever were before. And I just want to make sure that you go to our website, citizensnyc.org, support us. You can support us by just giving of your time, signing up for our mailing list, volunteer to give us your talent, like these folks on this wonderful panel are doing, or for those of you who have the financial wherewithal to also support us in general, because your time, talent, and treasure all matters. So really excited. Make sure you ask all the questions. Ownership is one way to get access to wealth, and wealth is the access to getting power and being able to influence your community. So thank you so much. And Anthony, I hand it back to you.
All right, thank you, Rahsaan. I really appreciate that, and again, thank you again for Citizens Committee for supporting this endeavor here this evening. We really appreciate it. I'm looking in the Q&A, and of course, Joe, the questions are primarily targeted toward your topic. One of the questions is, how does bankruptcy affect one's credit score?
So I definitely think the problem is, if you're in a situation where you're going to file bankruptcy, you already have probably a credit score that is not good. So I think it helps you on the way to recovery, because now you've cleared your debt and you're on the path back, and gradually it will improve. So I couldn't give you exact numbers or figures or how it exactly works, but certainly when you're thinking of filing bankruptcy, you have a high debt load, or you're having credit issues. So it's one, I think it helps, and it's a bandage to help repair.
And in your experience, Joe, is there certain timelines by which credit scores generally tend to rebound after someone's debts are discharged in bankruptcy?
I'd have to, I'd have to look into that. I'm not sure. I know that maybe I could answer it in a different way. I know that I've seen people that after filing for bankruptcy immediately obtain pretty close within months are able to obtain certain levels of credit card. So you think, look, I just filed bankruptcy. I had a bunch of debt, but pretty soon thereafter, within several months, there are certain credit cards. Potentially, they're going to be maybe higher interest rates, or maybe they'll even be secured cards. But I think, within several months, you'll start. But I'm not sure the direct correlation to credit score, but I think that's probably evidence of the improvement, that it does help pretty quickly.
And the follow-up question for you, Joe, is, are there bankruptcy lawyers? Presumably, I'm going to elaborate. I presume the question is, are there lawyers that are bankruptcy lawyers that specifically represent creditors, and bankruptcy lawyers that specifically represent debtors?
Yes, absolutely. I mean, there are a few that could do both, but mostly, either you have specialties, either folks that do individual or corporate bankruptcies on behalf of debtors, the people filing, or you'll have folks like myself. I do a lot of creditor work, although candidly, my preference would be to do debtor work. It's just where my career path took me.
Understood.
Yeah.
And Tony, this question is for you. After hearing the remarks that you provided and the details of the home lending process, if somebody was interested in reaching out to you and your team and they wanted to begin, how would you recommend they contact you or your team members?
Just call my cell phone.
That's how you recommend beginning?
Yeah, email, cell.
What is your email address? You want to share it for our viewers?
Yeah. Can I put that on the chat somewhere?
So I tell you, why don't you go ahead and just say it verbally, and then
it's just tjao@investorsbank.com.
tjao@investorsbank.com. All right, thank you, Tony. And same for you,
Thank you.
Christina. In the event someone wants to follow up with you directly to get a little bit more consultation, how would you recommend it?
I'm just going to put my email in the chat, and just because it's pretty long.
Oh, okay. Is it in the? Go ahead. If you can see that, yeah, go ahead.
Yeah, I can see the chat.
Again, to our viewers, we appreciate you, because that's all of our questions that I see. We appreciate each of you for supporting the Brooklyn Bar Association, for supporting Investors Bank, for supporting Citizens Committee for New York City, and taking time out of your busy schedules to join this program. And wish you all a good and safe evening and enjoyable summer. Thank you.
Thank you.